Hello and welcome to the DIY Investing YouTube channel. We're working through every company in the S&P 500, and today is Cummins Incorporated, ticker CMI. Over the next few minutes, I'll discuss my thoughts about the valuation of this company and its business quality. The market cap of this company is $29 billion. Enterprise value is $30 billion. We're working through every company in the S&P 500, but today we have machinery industry. So this company designs, manufactures, distributes, and services diesel and natural gas engines, electric hybrid powertrains, related components. 5 segments: engine, distribution, components, power systems, and new power. Now, what I find interesting about this is this sounds like a relatively good business. Anything you have, like machining and an industrial company like this, there's going to be a lot of technical expertise. There should be a pretty decent moat around a business like this. It's going to be hard to enter this market. You need a lot of expertise, probably a lot of capital. So I like what I'm seeing here. This is the type of business that could be very, very good. Looks like they also offer aftermarket parts, so you have some pricing power usually in that sort of market, but clearly producing quite a lot of different things. Now, return on invested capital. This sort of chart can tell you a lot of things. One of the things you want to see first, of course, for a high-quality company is 20 straight years of profitability is best. 19 at least is good, so that'd be 1 year of losses in the last 20 years. This is a 20-year chart. We have 20 straight years of profitability because not a single year goes negative. So that's a first good sign for a high-quality company. However, what I don't like is it's not very stable. You can see the cycles in their business as it goes up for 3 or 4 years, down in 2009. Now, 2009 was a recession, so that's understandable, but then it goes up again and down again. Down, up, down. So you can just see the cyclical waves of this business. I don't really like cyclical businesses. They're very hard to predict. I mean, if you think about on any 1 year here and you're trying to project forward, what do the next 10 years look like? Well, in 2003, maybe you say, hey, the returns are 2%. Now, in 2006, you might project, maybe 18%, but then 3 years later, you've dropped in half. If you project out from 2011 at 28%, you haven't matched that since then. So it's very important for predicting the future of business that you don't have these big cycles. So for me, this is a sign of an average company. Again, these returns are actually quite good. I mean, you look at this and the 10-year average here of 15% is very good. The 20% average here for return on equity is exceptional. I want this number to be above 10%. I want return on equity above 15%, and I need those numbers that way to give me a 10% plus return in my investing strategy. The way this is structured is you should be fine. If you can handle the volatility, this might actually work out to be a really good company, really good return, but I don't like it for predictability reasons. So that's why I'd say it's average, because you have good returns, but it is cyclical. An average business is cyclical. Now, one thing that's interesting here is your valuation ratios. PE of 14.6. That's a good price. I like to buy companies at a PE of 15 or less. So when you get a PE of 15 or less with a return on equity of 20%, that's really attractive. That could be a very strong return. Your 10-year CAGR is decent. You have revenue growing at 3% a year, but assets are growing at 7%. So the fact that assets are growing about 3 to 4% higher per year than revenue is a poor sign. It's why you're seeing declining returns over the last 10 years. I mean, you think about this, you've increased your capital base substantially faster than you've increased your revenue and faster than you've increased your free cash flow or EPS, which is why you're seeing return on invested capital is dropping, because you have more capital today, but not as much revenue and earnings on a per capital dollar basis. So that's what you're seeing here, is this declining returns over time. But revenue growing at 3% is respectable. That means that a PE of 14, 15 is probably fair value. This is probably a fairly valued business, average business trading at fair value. That could be something that many people would be interested in. Now, one thing to be aware of, man, I got sneezing recently. So one thing to be aware of when you look at this business, we need to dive in and look at gross margins, how they're doing. Now, what I like is that the gross margins are actually fairly stable. Although you're cyclical on a return on invested capital basis, you don't see a lot of variation here. 25%, 24%, 25%, 25%, 25%, 25%, 24, 25, 24, 23. This last year is a little concerning because you did finally drop below 24%, but you can see it's fairly stable gross margins over the last decade. Pretty reliable there. In addition, the operating margins holding pretty steady right around 10% with some recent declines. I don't like those recent declines. They're a little concerning, especially because it looks like you basically peaked in earning capability in 2019. But of course, the last 2 years were COVID. So you have to judge for yourself what kind of impact that would be. Now, One thing that tells me that maybe the future is not going to be as good as the past is you can see this massive dividend growth is substantially going faster than earnings per share. So earnings per share have not even doubled over the last decade. To double earnings per share in a decade, you need EPS growth of about 7%. We're growing at 4%. So you've gone from $8.67 to $14.61. Okay, so you have that number there, but then you've tripled your dividends. You've gone from $1.80 to $5.60. How can you grow dividends that much faster than earnings? It's because you're not having the ability to reinvest at the rate that justifies these returns. You would not be able to grow your dividends this fast if you were actually able to reinvest at 20% and 15% rates for high periods of time. Instead, you would have high revenue growth and you'd have a high EPS growth. But with low EPS growth, you're having low in reinvestment. It just means that these high returns are due to high investments in the past, and those high investments shouldn't be expected to repeat in the future. Not a great sign for investors, but I mean, clearly you see signs here of a pretty good business, average, good business, fair value, everything along those lines, but nothing exceptional, nothing that tells you you're going to have 10, 15% returns going forward because you're not seeing those high reinvestment rates. Solid returns, respectable returns, you might have high single digits, maybe close to that 10% rate, depending upon multiples expanding or whatever, but it's not just drawing me in immediately, but respectable. Now, if you're enjoying this video so far, please hit that like button. Don't forget to subscribe. I'm putting out videos Monday, Wednesday, and Friday, working through every company in the S&P 500. And at the end of this video, I'll have a link to the playlist where I've already covered over 120 S&P 500 companies. So if you want to see those, you can watch those at the end of this video, or you can subscribe so you can get notified as I upload new videos each and every week. Now let's go to the income statement. So you are seeing pretty strong growth here. Revenue's growing, 50%. Cost of goods sold is growing 50%. So that everything's growing in line with the business. That's all good. Again, this matches what we saw earlier with margins. You're maintaining a straight margin there. Same with SG&A. Nothing's growing exceptionally fast or outside of the business. It seems like the business is being pretty well managed. Now, one thing for why you're seeing this EPS growing as fast as you did was that you're buying back shares. So look, you start the decade with 190 million shares outstanding, and you've retired about 20% of the shares over the course of the last decade. That's causing a 2% boost in your EPS. So if we go back to the overview, that's what you're going to see. The difference between this 2.9% revenue growth and 4.3% EPS growth is owing to be almost entirely from those share buybacks. So without additional share buybacks, you're not going to get that sustained growth. What that means is those share buybacks are coming from your net income. So you can't double count that. The true sustainable growth rate for this business is going to be more in line with revenue than with EPS growth. So don't plan on 4% EPS growth. You should plan on 2.9% revenue growth plus whatever you get from your dividends. And that's how you should balance out expectations for the future. Now you've doubled your PP&E, a little bit more than that. How much your debt? And you've 5x your debt. So, think about this. Your earnings have not doubled, but you doubled your PP&E. So your assets are going up significantly. You've doubled your inventory. You haven't doubled accounts receivable, so it's not all bad there, but you've basically doubled your total assets from 12 billion to 24 billion. And yet you've not fully doubled your earnings. That's a bit of a concern. In addition, you've 5x'd your long-term debt. You're taking up even more of your equity in the form of debt there now. You do have more cash, so it's offsetting a little bit. But something to be to think about, that this is the sort of thing that happens when a business growth slows. You start to try and compensate for it with debt. You start to do that with extra assets, and it can disguise a deteriorating business with those numbers. You can see buybacks every year. I'd like to see that. Those buybacks are exceeding substantially the stock-based compensation, so you are having share counts go down over time. That's good. You're certainly having to reinvest every year, so there's not like this is going away. You do have acquisitions every year, which is kind of interesting. Lots of small acquisitions. I don't really know what that is, but you'd want to study that as a potential investor. But nothing jumps out here as super interesting or amazing. You can see the return on equity has been high for a while. Return on invested capital is high for a while. But really all that's telling you is because your growth rates aren't in the double digits, that's historic returns. It's not current returns. Or if it is current returns, the actual reinvestment rate is quite low. So that's about it for Cummins Inc., ticker CMI. I am going to pass on this and it won't go on my watch list simply because I don't like the cyclicality on the return on investment chart. It's not as predictable as I'd like to see. Although we have the 10-year median returns that I like, I want to see more predictable numbers here, which would allow me to project more in the future. In addition, I want higher revenue growth rates. I would really like to see this in the double-digit range, and that's going to be hard to achieve double-digit 10 to 15% rate of return as an investor if I'm not getting that on the revenue line. And even though the valuation is reasonable, I think this is probably a fairly valued business for someone else, if you're willing to handle the volatility here. But I think it could be even a little overvalued if you have the same discount rates as me and you want 10 to 15% rate of returns on your investments. But if you're okay with single digit returns, then this could be an attractive business for you, depending upon how that is. But of course, you'd want to study is anything in this history causing some of these numbers to be weird. Now, if you enjoyed this video, please hit that like button. Don't forget to subscribe, hit that subscribe button and ring the bell. That'll give you notifications that I upload new videos Monday, Wednesday, and Friday covering new stocks each and every week. So we've already covered 120 S&P 500 companies. Hit that playlist so you can get the full list of the ones we've already done. We started today and working all the way to Z. And so I hope you'll join me for that ride. If you like this software that I'm using quickfs.net. And you can sign up for their free or paid version through the affiliate link that I have in the description below. If you use that link, it is a good way to support this YouTube channel because I get a commission if you were to sign up and use that link. So please consider signing up through my link. It won't cost you anything more if you sign up. You can sign up for free. You can sign up for paid. There's no extra cost for using my link. It's just a way to support me and support this channel. So thank you for listening. And until next time, stop paying fees, start building wealth.